welcome back to Market Shares. I'm your host, Tony Blodgett, and today, I've been really not wanting to do market updates, but I think we're going to do a quick market update, just bring you up to speed on what's going on. And again, we are back to some optimism. This is almost getting ridiculous. We are back to some optimism about what's going on with the war in Iran and the Strait of Hormuz. I thought it was such breaking news the first time we talked about the Strait of Hormuz and how it was a choke point for oil. And now, all we hear about is the Strait of Hormuz. It's getting old, but nonetheless, it is definitely been a factor. And every time we get word that, peace talks are back on, or we're going to open the strait back up, interest rates get better a little bit for a period of time. And that's what's going on this week. So I just want to give you a couple updates and maybe a little forecast on what's going to happen towards the end of this week with the jobs numbers. We get a little peek at it here with the JOLTS report that already came out. I'm recording this on Tuesday. It's coming out on Friday. You'll know the results of the BLS job report, so I'm not trying to claim that this has all the answers, and I don't know that it really matters that much, but I want to talk a little bit bigger picture. So as of today, U.S. Treasuries, they're improved today, 4.64. Not a great number. We'd definitely love that to be lower. But if you're watching the MBS market, what you've seen is yesterday, Monday, we had a decent day. We were up, 19 basis points, another 31 today. So that puts us up 50 basis points in the last 2 days. I mean, that's good. We'll take that. And I think Monday, what was driving that was just the word that there are further talks between the U.S. and Iran and the opening of the strait. And then today, on Tuesday, that was even more emphasized by Scott Bessent, the Treasury Secretary, who was speaking this morning and said that the strait, could be open as soon as today or tomorrow, so Tuesday or Wednesday. As a result, we're seeing, a good week so far for mortgage-backed securities, and we need that. We need the relief. I'm going to talk next week about strategies that loan officers are using to win in this market despite the challenging interest rate environment. But let's be honest, lower interest rates would definitely make it easier. So it looks like we have a glimmer of hope that that's starting to happen. As a result, oil prices dipped down to $76 a barrel again today. So one thing that Scott Bessent did say is that he thinks that oil prices could continue to even go lower than that due to the pent-up inventory that's just sitting over there, waiting to go through the Strait of Hormuz, that we have essentially inventory stacked up on these ships. And that and other factors could lead to even lower oil prices. And as I've talked about ad nauseum on this podcast, what I see happen is that when we see overall oil prices lower, eventually interest rates catch up with that. Not directly related, but they do tend to head in the same direction. And that's primarily driven by the inflation, right? So the other thing that Scott Bessent said is that he sees core inflation continuing to lower. Keep in mind, the core inflation strips out the energy. So he's talking about the main driver there of the core inflation is rents coming down lower. And we've seen reports of rents, different surveys say different numbers, but down, new rental contracts down about 3.3%. This is that shelter component that you've heard us talk about. That's a very lagging number. It lags way behind and could help bring down core inflation. So overall, Scott Bessent's comments, obviously as a spokesperson for, Scott wants, he was appointed by the administration. He wants, rates to be lower. He wants the perception of lower rates in the future. So take that for what it is. But everything was very, dovish, if you will, about, what's going on with the market. Lower oil prices, opening up the strait, softening of core inflation, all good news if you're watching the bond market very closely. So this week we did have the JOLTS report come out, job openings and labor turnover. And it was basically in line with expectations. But the takeaway that I got from that was that two areas that we've seen a lot of strength in the labor market over the last, year or even 2 years is that leisure and hospitality was actually down, and the healthcare sector was down significantly, like 147,000 jobs in healthcare. So, those are two areas that have been bringing strength to the labor market. Now, I think the overall labor market is still soft, right? Like that's what was being talked about by Jerome Powell as we were, those last, couple rate cuts. They had started turning away from looking so much at inflation, and then we're looking at, the labor market, because that's, maximum employment is another mandate of the Fed. And then we started seeing some strength come back to the jobs numbers. So it's going to be interesting, and I mentioned this last month, on what this Friday's BLS jobs report looks like. The expectation for Thursday's ADP numbers is about 70,000 new jobs, and the BLS outlook is expecting 80,000. So any sort of a miss from that, I think, could be good for interest rates. They're expecting the unemployment number to stay the same at 4.2%. So I'll be watching those numbers closely come Friday. And when you take that on the tail of all this good inflation news, maybe we're setting up the end of summer to be a little bit of a correction with these interest rates. Another Fed, actually a voting member of the Fed, Anna Paulson, also was on CNBC yesterday. Also very dovish with her comments. This is a voting member, and she said that she thinks the Fed funds rate is, still creating a bit of a restrictive stance, and will continue to do what it needs to do. And there wouldn't be any need to raise interest rates. If you remember, at the last Fed rate meeting, we had 3 dissenters that voted, felt like there should be an increase in the Fed funds rate, unlike the previous meeting where it was unanimous that there would be no Fed rate hike. So 3 of the voting members said that there should be. She was like, look, I don't see that. I couldn't disagree more, basically, and that she still sees inflation going lower. And she even made some comments that said, look, if you took out all the oil and tariff disruption we've dealt with, overall inflation is right where we want it to be. So anyways, you guys, just a lot of, I'm trying not to be overly optimistic here, but I do want to give you the glimmer of hope when it exists. And everything I'm seeing is we got a great start to the week. We got, a nice improvement in mortgage-backed securities, a little step down in U.S. Treasuries. We got, nothing surprising so far with the jobs numbers. We got to wait and see what happens. And we have the talking heads saying the right things about inflation and the war and, the potential for the Feds to continue to keep rates where they are. So, look, these are all things that we just need to keep an eye on. If you are watching this podcast and you haven't really checked into what happened with those labor numbers, the BLS numbers, I'd go check it out just so you know kind of the direction of things. Maybe it'll give you an idea of where rates are going to open, next week. And definitely tune in to next week's episode, you guys, because I'm going to give you what I think are the top 5 areas, not what I think, what I know are the top 5 areas that top producers are winning business despite these interest rates. And I know that because I surveyed them, and this is the feedback that I got. So I'm just sharing with you what I see top producers doing in this market, to not sit there and, talk about the challenges that are happening, but how they're overcoming those and finding winning strategies and solutions for their buyers and their referral partners to continue to grow their business in what is arguably one of the most challenging markets that we've been in. So that's my take, you guys. I'm going to try to be optimistic as we move through this week. I'm going to hope that what we've dealt with here since the end of February might be coming to an end, and I'd like to see oil prices keep going down. I'd like to see interest rates follow them down. I'd like to see the Fed be optimistic about no need to further increase interest rates in order to get us there. Although I will say, I've heard multiple people now, including Barry said it on his update in the morning, and there was somebody else that I was watching that said, at this point, if we're really that concerned about inflation, a little bit of a Fed rate hike to tame that inflation might actually be looked at favorably by bond traders, and we might actually see mortgage rates improve if we see a Fed rate hike for the right reasons. And, it's always followed with that commentary afterwards, but I don't know. So I don't think it's going to be the end of the world if we see a Fed rate hike, but I'd rather not. I'd rather see, marketed moves on inflation going in the direction we want it to without that. So we'll keep an eye on all that stuff. And if we see anything meaningful that you need to know about, we will make sure that we share it right here on Market Shares. So if you enjoy this content, do me a favor and subscribe to the channel. And more than that, share this with somebody. Let someone else know what we're doing over here at Market Shares. I think mortgage and real estate people benefit from these short little episodes that we do here. They're easily digestible and hopefully have you walking away from this episode with something that you can implement in your business or that makes you just a little bit smarter about what's going on in the market around you. So until next time, take care.